Hey folks, see Rachana Ranade here and I welcome you all to another interesting lecture on bees. I know it has got nothing to do with honeybees, but let at least as sweet as honey, let's hope that our financial education lecture is as sweet as honey tastes. Now let's understand what are bees. Okay, bees are nothing but benchmark exchange traded schemes. I'm sure you might be like, what is this now? So let's understand each and every terminology one by one. The very first word is benchmark. Benchmark means what? It's something like a standard, something with which I can compare my own performance. Okay, so have we come across the concept of benchmark right back when we were in school? Yes. So just as an example, if teacher would have told your parents that your child has scored 85%, okay, now for your parents to understand is 85% good or bad, possibility number one can be they compare your performance with average performance of the kids in the class. Okay, generally parents would compare it with the most brilliant person in the class, but let's consider that aside. If they compare it with the average performance in the class, can I say on an average assume that kids have gotten 83%, then your performance is better than others, so your performance has outperformed the benchmark. Okay, what was the benchmark? Average marks which the students scored in the class. Similarly, for stocks, what can be a benchmark? Benchmark, a standard with which I can compare, that can be like Nifty, that can be like Sensex. Okay, this is just an example. So I hope you have understood the concept of a benchmark. So in the whole word of bees, benchmark, the first word is clear. What is the second one? Exchange traded scheme. In that exchange, what exchange? Exchange means exchange where you trade in stocks, in commodities, in other securities. Best examples of exchanges BSE, NSE, right? So benchmark समझ में आ गया? Exchange. Now traded schemes. So exchange traded on the exchange schemes. Now scheme is nothing but like a theme. Okay. So for example, a theme can be like investing in banks. A theme can be like investing in blue chips. A theme can be investing in gold. Okay, so all these are different themes, different schemes. So I hope you have understood benchmark, exchange traded schemes, that is nothing but bees. Now let's understand what could be the different types of bees or different types of ETFs. I'm sure you might have heard about the word ETF, but just in case if you have not, we are going to talk about ETFs in another 1 or 2 minutes. Okay, so till then, let's understand what are the different types of bees or different types of ETFs. Possibility number one, they can invest in a specific thing or they can invest in a mixture of things. Okay, you might be like, what is this? Let me give you a simple example. Consider a fruit, investing in a fruit, single fruit, or investing in a fruit salad. Okay. Now, what is investing in a fruit? Investing in a fruit is like investing in a single commodity. Okay. So, if I were to turn this apple into gold, in this case, I can say that I am investing in gold through a gold ETF or through gold bees. Okay. So, in this case, what is the scheme? Scheme is investing only in a single theme, single scheme, which is of gold, nothing else. Okay. Possibility number two, now it's a fruit salad. Now it's not only one fruit, there are bunch of fruits, different fruits mixed into a fruit salad. Now instead of multiple fruits, if I go with multiple banks shares, that will be like bank bees or it'll be like bank ETFs. I hope you're understanding this, right? So if you remember, bees, S stands for scheme. Scheme can be like investing in a single thing, single theme, or it could be a mix of a theme. Okay, so there could be few other ETFs as well. Like you might have heard about Bharat Bond ETF, in which a majority of public sector undertakings are the ones in which the investment is done. Okay, so I hope you have understood that there are multiple. It could be a sectoral ETF, like it could be a bank B, bank ETFs. It could be a commodity ETFs like a gold ETF. It could be it could be like bond ETFs like Bharat Bond ETFs. But more on ETFs is coming up in the next part of the video. So just in case if you don't know what is an ETF, ETFs are nothing but two investment ideas brought together. Okay, so understand ETFs is nothing but a combination of something like a stock plus mutual fund. Now, why is an ETF like a stock? First of all, let's understand why it's like a stock. Number one, because it is traded on the stock exchange. That's why it's like a stock. Number two, its prices keep on fluctuating every second, every microsecond. That's why it's like a stock. Number three, if we were to buy an ETF, then we can set a limit order. I'm sure you might be knowing that there is something like a market order, there's something like a limit order. We can also set a limit order for ETF. That's why it's like a stock. Number four, whenever we buy an ETF, it directly comes to our demat account. That's the reason why it is like a stock. Okay, so I hope you have understood why ETFs is very similar to a stock. Now, let's understand why it is like a mutual fund. But wait, not like any mutual fund. It's very close to an index mutual fund. Now, what's an index mutual fund? It tracks an index. So, just like it can be like a Nifty ETF, like Nifty BeES, right? Second point, it has comparatively lower expense ratio. Now, what's expense ratio? If you want to know that, I've already covered it in one of my previous videos. You can check it out later. And number three, the portfolio turnover ratio is also comparatively less if I compare it with actively managed mutual funds. So I hope you have now understood what is an ETF. ETF is nothing but a combination of stocks and a combination of index mutual fund. Instead of saying a combination directly, it's very close to both these concepts put together. Well, I hope you have understood what is bees. You also have understood what is ETFs. But now the big question, what is the connection between bees and ETFs? The simplest connection is nothing but bees is a type of ETFs. Okay. When was this first launched? Nifty ETF was Nifty BeES basically was the very first ETF which was launched in India way back in 2002. Now, if I'm talking about buying Nifty, can I buy Nifty directly? No, I can't. I can't buy Nifty like I'm buying a stock. I might have to buy its future or its option. But if I'm scared of futures and options, then what is the scenario? What is the alternative for that? I can buy Nifty BeES. Okay. Now, Nifty BeES, but will I have to invest a lot of money? So, for example, one unit of Nifty is today, as I'm shooting the video, it's somewhere around 14,500. Does it mean that if I were to buy 100, 14,500 into 100? No, no, no. One unit of Nifty B is approximately 100th of Nifty. Okay, so if you check this out on the screen as I'm shooting the video, Nifty had closed on the previous day on 14,507. So, iska 100th will be 145 rupees roughly. Okay, but if you now check Nifty India ETFs, right here, it is around 155. Okay, so roughly 100th of Nifty. So, I hope you have understood that how you can get an exposure to the best 50 companies, to the top 50 companies by investing a comparatively very small amount. That is the important feature of Nifty BeES, number one. Number two, if I were to compare Nifty BeES with some other BeES, like what? Like gold BeES, like bank BeES, then which one is comparatively cheap if I'm considering expense ratio? Okay, again, I told you I've covered expense ratio in one of my previous videos, but if you can check it out on this table again, for Nippon India ETF Bank BeES, the expense ratio is 0.18%. For Nippon India ETF Gold BeES, the expense ratio is 0.82%. But if I'm talking about Nippon India ETF Nifty BeES, it's just 0.05%. So I hope you have understood that it's also comparatively cheaper. Expense ratio is comparatively less. And one more important advantage of Nifty BeES is that it's absolutely transparent. I know where my funds are going to be parked. So if I invest in some large cap fund, in some blue chip fund, I don't know which blue chip, I don't know which large cap, I don't know when the investment manager, when I don't know when the fund manager basically is going to shuffle the stocks. But here I know it's going to be only Nifty stocks. So can I say transparency is also one of the biggest advantages? Answer is absolutely yes. Now you might have understood that ETF look really good, look pretty attractive. Then has ETF grown very nicely in the past few 10 years or not? For that, just have a look at this chart. ETFs have grown at a CAGR of 70% in last 10 years. That's a mind-blowing growth. Now, what could have been the possible key drivers? Number one, EPFO, which is the Employers Provident Fund Organization, they have started investing in Nifty ETFs and through in other ETFs. Number two, even our government has done a lot of divestment through ETFs like Bharat Bond ETFs. And in fact, if you are aware of this, they have done multiple series of Bharat Bond ETFs. So more and more ETF, more and more exposure, more and more people are going to invest in ETFs, and more investment in ETFs. This graph is going to go higher and higher, right? The second one, which I would like to also show you, the second graph talks about percentage of ETF AUM to the equity AUM. So, in simple words, if people are investing in equity mutual funds versus people investing in ETFs. Okay, so assume that out of 100, which is the total equity AUM, out of 100, just barely 1% was being invested in equity AUM, in ETF AUM, sorry, way back in 2009. And if you now check in 2019, roughly, this number is touching 12%. So out of the total equity AUM, 12% goes to ETF AUM. I hope you're understanding that the ETF percentage is going up and up as the years are passing by. Let's move on and try and understand that. Assume that I'm investing in Bank Nifty, one of the most famous in F&O space, Bank Nifty, versus if I invest in Bank Nifty but through Bank BeES. Okay, in that case, will my returns be exactly same? Do you think so? Or do you feel that the Nifty BeES might give a little bit less returns as compared to the Nifty returns, Bank Nifty returns? The second answer is correct. Your Bank Nifty BeES will be giving you a little bit less returns as compared to your Bank Nifty. Why? Because certain expenses are involved here. Don't you think that there'll be some kind of management fee involved and some other expenses also involved? The answer is obviously yes. Well, do we have any data to prove this? Why not? I'm just comparing Nippon India ETF Bank BeES with Nifty Bank TRI. TRI is Total Return Index. Well, I have explained what is Total Return Index absolutely again in detail in my course on Magic of Mutual Funds. So if you want, you can have a look at that as well, right? So coming back to the discussion, if you check the 1 year return, for Bank BeES, it is minus 37%, 37.52. I'm ignoring the decimal points, but Nifty Bank is minus 36%. Okay, so Nifty Bank, both are in negative, but at least Nifty Bank Nifty is a little bit less in negative. If I compare 3 year returns now, Bank Nifty is 3.23 minus, but Nippon India Bank BeES are minus 3.82. So again, a little bit worse. And if I talk about a 5 year return, which is a positive return, Bank Nifty has given 1.67%, and here if I talk about Nippon India BeES, Bank BeES, then it's 1.12% only. So I hope we have understood that everywhere the index is going to perform a shade better than the index BeES. Now let's understand mutual funds or ETFs. Which ones are better? So what we've done is that this is Money Control website, and here we've just tried to rearrange or arrange the returns data in a descending manner. In simple words, the mutual fund with the highest return is right there on number one, and the returns go on decreasing, right? So for example, you can see Quant Small Cap Fund that is given like 75.17% return in 1 year. This is like an exceptional return, of course. But if you check from the highest one to the lowest one, which is DSP Healthcare, whatever could fit into the screen, it's still 51.68%. Okay, so mutual funds have performed pretty well in the last 1 year. Okay, these are somewhere around top 10 mutual funds which have taken into on the screen. Now let's compare top 10 ETFs. Again, descending order mein, you can see the returns on the screen. Motilal Oswal Nasdaq 100 ETF has given the best returns, 37.37%. And the last one being ICICI Pru Midcap Select ETF, which is 26.10%. What is this? What does this mean? It means that if I'm talking about top 10 returns for mutual funds versus top 10 ETF returns, mutual funds have outperformed ETFs. Recently, you might have heard about Mr. Warren Buffett saying that ETFs are way better than mutual funds. I feel he is not wrong, but in the US context, where the markets are absolutely mature, in India, where it's a maturing market, it's a developing market, in India, still fund managers do have a lot of scope to find out the gems and jewels which can give you better performance as compared to the index as well. So if you want to generate that higher return, ye dil mange more category, then mutual funds may give you better returns. But yes, if you're talking about a kind of safety, then ETFs can be better. Well, if you want to know how to buy BeES, it's as simple as buying any stock. So you go to your portal, just search for Nifty BeES or any other BeES, whatever you want to buy. Place how much quantity you want to buy, place at what price you want to buy, and it's as good as like you take a delivery of your stocks, you can take even delivery of BeES. So it'll be as good as buying so if you are buying Nifty BeES, it's as good as taking a position, taking a delivery of Nifty BeES, taking a position of Nifty without going into the F&O space. But if you want to buy Nifty BeES on the exchange, of course you need to have a demat account, and if you don't have a demat account, of course link is there in the description box. Now, if you want to understand the taxation aspect of bees, then just it's as simple as this. If I'm talking about a gold ETF or a bond ETF, they're taxed same like a debt mutual fund. You can just check out what are the rates for short term, for long term. In one, indexation benefits also apply. Okay, and if I'm talking about Nifty BeES, the Nifty BeES are taxed like equity mutual funds. Again, you can check what is the scenario for long term and what is the scenario for short term. Well, this last part is a little bit tricky. If you can understand it, fantastic. Okay, let's take this example. Assume I have Nifty BeES in my portfolio, and these Nifty BeES have already given me a 15% return. Okay, now what? I feel that market might crash. How will I protect my position? How will I hedge my position? Is there any perfect hedge for my Nifty BeES? Answer is yes. What? I can write a call, which call Nifty ka, obviously. Possibility number two, I can short the futures. Which futures? Nifty futures. Correct? So even if market falls, my BeES returns will fall a little bit, but the position, the derivative hedge which I have taken, that will give me good returns, and all in all, my profits will be protected, right? Can I do the same thing for mutual funds? Can I get an exact hedge? Answer is no. If I have a mutual fund portfolio, let's say it's a balanced fund, do I have an exact hedge for that? Answer is no. I don't have an exact hedge for it. Okay. So I hope you might have understood this last part of the video. A little bit advanced it was, but if you have, fantastic. If you haven't, it's okay. Try and read more about hedging and then you might be able to understand this. Well, I hope you have enjoyed this amazing knowledge packed session on bees. If you have, don't forget to share this video with your friends. Till then, take care. Jai Hind and bye bye.